If I had high credit card debt, I would not skip this video. I just wouldn't do it to myself. So we're going to go deep on how credit card debt consolidation boosts your FICO credit score. Consolidating credit card debt does one very specific thing to your credit score, and that one thing quietly sets the terms on every single loan you apply for afterward. A card stack, 0% business cards, a HELOC on a LLC-owned investment property or a home, a business line of credit, an SBA, even hard money or DSCR, or even a regular mortgage. Here's exactly what it does and why we fix it before touching anything else. So let's get fair up at the one number that touches everything, credit utilization. The percentage of your available revolving credit you're currently using, the single most impactful variable in your borrowing profile. Credit utilization makes up roughly 30% of your FICO score by itself, more than almost any other single factor. Run your cards up near their limits, and that score drops significantly. And every lender across every product type looks at that same score. High utilization drags down the score every lender looks at, regardless of loan type, and it's the single largest lever we can pull to actually boost your FICO score in one reporting cycle under 30 days. So, what debt consolidation actually does. Here's the mechanic. A term loan pays off those revolving balances directly, dropping your utilization from wherever it was down to near zero, and the term loan providers know that it's suppressing your score, so will actually give you great rates and terms even if you're sitting at a 650 entry point. So term loan funds pays revolving balances directly, utilization drops, falls from high to near zero, score jumps 40 to 80 points to be conservative in one reporting cycle, not months of rebuilding, one cycle. That single change in utilization is what drives the score improvement and really sets your profile up for everything that follows. Why this comes before anything else. This is why it comes first. Before we even talk about what you're actually trying to fund, it doesn't matter if the end goal is a card stack or a mortgage, this number affects the terms either way. So universal impact affects every loan product. Not just one, it's the common thread across all of them. Stronger starting position, fix it first, and every application that comes after starts from a stronger position and tier instead of fighting uphill. And it's not a separate strategy, it's the first move regardless of the goal. Not an optional step, but the most powerful and foundational of the whole approach. So what it does for card stacking typically wants a credit score of 700 or higher, and that 40 to 80 point jump is going to put you in that range if you're starting at 650 plus. And utilization is often the specific thing capping your approved limit, even when your score technically clears the bar. Clear that utilization out, and the same lender frequently comes back with a materially bigger number on the second look. The approval threshold isn't the only thing that changes, the limit does too. So card stacking threshold, 700 plus credit score required, high utilization caps your limit even when you qualify, lower utilization, bigger approved amounts. So guys, get it sorted. And it also frees up cash flow from those high interest credit card debts. What it does for a HELOC and business line of credit. So HELOC on a primary loan typically wants a 620 credit score plus. Lower utilization improves your rate tier, not just your approval odds. HELOC on an LLC property requires a 700 plus FICO when the property is held in an LLC because it reflects the higher risk. The bar is higher and utilization matters more than ever. For a business line of credit, most still require a personal guarantee, meaning your personal credit gets pulled regardless of how the business looks. Lower utilization improves your rate tier on both HELOC and business lines, not just whether you get approved, but what you pay once you are, so affecting the interest rate as well. What it does for SBA and hard money. This is interesting because SBA lenders typically want a practical floor around 680 for the borrower. Utilization feeds directly into the debt to income picture where they're underwriting against. It's not just a score check, it's a full financial picture. Hard money is asset first. Your credit score is not the primary driver for approval, but even there, a stronger score can still shave points and rate at the margin. Most experienced lenders will tell you the same thing. Now, there is a difference between debt to income ratio and utilization. Hard money lenders are looking at your FICO score, not your debt to income ratio. So the added debt of the term loan isn't going to impact it. It's the boost of FICO score that actually improves your odds. Even in asset first lending like hard money and DSCR, A stronger credit score creates margin level advantages that compound over time and give you better rates and terms. So let's look at what it does for a DSCR loan and even a regular mortgage on a home. DSCR loans price you in tiers based on credit score. The best pricing generally starts around 720 to 740. Moving from high 600s into that range can meaningfully lower your rate on a rental property loan and also the DSCR ratio. So entry tier is going to be 680, qualifies but a higher rate pricing. Better tier is at 720 plus, improved rate band on DSCR and mortgage. And the absolute best tiers are going to be 740 plus, top pricing on DSCR, mortgage, and most products as well. A standard mortgage works the same way. Your score band sets your rate tier directly, and your overall debt picture factors into what you actually qualify for at all. So one move every door. Put it all together, and here's the picture. Every one of these products is reading some version of the same underlying number. Fix it once with a properly structured term loan, and it works in your favor across all of them simultaneously. So your SBA, better rates and terms at a 680 floor. DSCR loan, we want to get up to the 720, 740 for the best pricing. Standard mortgage, score band sets rate tier, business lines, personal guarantee pooled. So one-time catch, fund loan, report paid, apply. The score improvement shows up once those balances actually report as you paid down, which is typically one billing cycle, not the day the term loan funds. Time your other applications to land after the reporting dates on all cards, and you're applying with approved number instead of the old one. Sequence matters here. So the whole lands in one place, one move, and it's working in your favor everywhere at once. Term loan pays off revolving balances, utilization drops, shifts, 30% of your FICO score shifts. That single factor moving can push your FICO 40 to 80 points in one reporting cycle under 30 days, could even be as quick as 1 week, depending where they land. And every lender after this prices you on the new number. That's card stacking, HELOCs, business lines, SBAs, DSCR, mortgages, all of them benefit from the same improvement. Now, how we help with this? Our approach. We check your utilization before recommending anything else in the stack. The sequence is intentional, not arbitrary. Check first, assess your utilization before any product recommendation. Structure to clear it. The term loan is built to eliminate the number, not just put cash in your account. And sequence what comes next. Time follow-on applications to land after the improvement has reported. If you want to know exactly what your utilization is doing to your options right now, book a call. We'll look at your file and show you what fixing it first actually opens up. So gapfunded.com/apply. Pretty clear there. Hit the link in the bio and have a chat. Worst case, you walk away with a game plan because we're talking days, not weeks. Debt consolidation is always the first move, not because it's flashy, but because it's the one thing that improves everything that comes after it. Once your file's ready, there is more walking through each of these tools in detail. Card stacking, HELOCs, business lines, SBA, DSCR, and mortgages. Every one of them starts from a better place when this number's clean. So the key takeaways in one screenshot. Utilization is 30% of your FICO, the single biggest lever you can pull quickly, more impactful than almost any other factor. 40 to 80 point jump, one term loan, one reporting cycle, a score improvement that touches every product after it. Timing is everything. Apply after the balances, report as paid, not before. Sequence determines whether you get the old score or the new one. One move every door. We're talking card stacking, hard money, HELOC, SBA, DSCR, and mortgage, all reading the same number. Fix it once, and it works everywhere. I'm Mick Wadley, founder of Gap Funded. Let's go close something. And if you adored this video, if you absolutely loved it, go down, smack the subscribe, flog the bell, and I'll see you on the next one.